Well, good afternoon. Happy Friday. Mark Milam here, November 8th. Let's get right to it. Certainly a volatile past couple of weeks, and none more volatile than this past week. Of course, on Tuesday, we elected a new president, and then 48 hours later, the Fed cut the Fed funds rate by 0.25%, bringing the target rate down to 4.75%. Interesting news and interesting how the market reacted. We actually saw a good bit of volatility. Let me bring this closer into view here. Bear with me one moment. You can see what's been happening with mortgage-backed securities. They've been selling off now since the middle of September, but we started to see a little bit of rebound here over the past few days. In fact, this was yesterday where we saw a nice rebound in mortgage-backed securities. Turns out everyone attributed this improvement to the Fed's rate cut, but really this had begun in earnest well before 2 p.m. when the Fed had made their decision to cut Fed funds rate. Ultimately, what we believe this was all about in terms of this repositioning here of mortgage-backed securities, or really the 10-year Treasury, is traders unwinding positions after the election. There was a lot of volatility in the bond market moving into the election based upon one candidate or another candidate's policies, and would those be inflationary or would they not be inflationary? And we see that big Thursday move as simply just being the unwinding of positions. Nothing long-term there, and we can see it market relatively flat today as we head into the holiday weekend. Ultimately, the biggest concern that we have on the table here is what's happened with the 10-year Treasury since the Fed cut the Fed funds rate back on September the 18th. That's really the story and how it's been affecting housing. And we can take a quick look here at this chart. So this is every Fed rate cut cycle since the mid-1980s, and here we are, this black line, and you can see it's just gone up at a pace that we haven't witnessed before in other Fed rate cut cycles. Now, we had a lot of volatility in here as we approached the election. In fact, some of this happened as early as this past week, but we're finishing out here, which is far higher than any other Fed rate cut cycle that we've seen. And as the 10-year goes up, so do mortgage rates. So what's causing that? A lot of opinion around that. Is it the fact that the Fed's cutting the Fed funds rate and could reignite inflation, aka Arthur Burns back in the 1970s? Well, that's certainly a potential possibility, and several of the macroeconomic economists that I follow would echo that. There's also a concern that really, regardless of who was going to win the election, we don't have anybody focused on reducing the deficit. And if 72 cents on the dollar for our spending is coming from tax revenue, while the other 28 cents are coming from selling our debt, that puts upward pressure on that 10-year Treasury. And certainly we are not in any time that we've ever seen before as it pertains to our overall debt, right, and our annual deficit. So the coming weeks and months are certainly going to play this out. Is it the Fed's actions, or is it the federal debt, or a combination thereof? So hopefully we'll get some relief on mortgage rates as we move into Q4. Hopefully we'll have a government that starts moving towards a balanced budget. That would put less pressure on interest rates as well. It'll be interesting to see how this plays out as we move through the balance of the year. If I can be of any service to you over the weekend, don't hesitate to reach out. Mark.Milam@highlandmtg.com. Thanks.